Netflix is one growth stock that's down 51% that I think you might regret not buying on the dip. I'm going to discuss why I think that's the case in this video, so let's begin. The first thing I want to highlight is Netflix revenue growth over the last decade. The streaming pioneer has went from roughly 5 billion in annual revenue all the way up to 31.62 billion in annual revenue. It has over 220 million subscribers, and if you count the single streaming service, Netflix has the highest total subscriber count across all the streaming services. Of course, the Walt Disney Company has more total subscriptions, but that's because it has three streaming services in Disney Plus, Hulu, and ESPN Plus. But just one service, Netflix is the leader, and over this last decade, it's gotten better and better and better at doing what it does, and it's gotten better because it's gotten more experience. It has learned from its content creation, from its licensing of third party content. It's getting better at learning which is the best way to spend money. Does it spend money on content creation or content licensing? And it's found the right balance between those two, and it's producing more and more hits lately as a result of having more and more experience and as a result of knowing its customers even better, right? So now it's got a long history. Well, I shouldn't say long, but it's got uh, over a decade of history on some of its customers, and it can tell what these customers are looking for, what type of content they want. And so by looking at that user data, seeing what they're watching and what they're spending the most time watching, Netflix can learn what new content to create. So with each year that goes by, Netflix's content spending budget becomes more effective. So each year it needs to spend less on getting the same amount of viewership because it's spending more effectively on the type of things that its viewers want to watch. So that's been a tailwind for Netflix over this long term. Not to mention, of course, the big tailwind for Netflix is the fact that streaming content is so much more convenient than watching through a traditional cable or satellite subscription, right? It's much more convenient if you can carry your subscription on your phone, on your tablet, on your laptop. That way it's with you wherever you go, right? If you need to take the train to work, you can open your phone and watch some content on Netflix. You can't do that with your cable subscription, right? You can only watch that when you're at home or in your office or wherever it is that it's connected to the cable service, right? So that's why it's much more convenient. That's why millions and millions of people around the world have been canceling their cable and satellite subscriptions and switching to streaming content instead. Netflix has benefited from that long running tailwind. That's got more room to go. That's got a lot more room to go. There are still a lot of people that are canceling and moving to streaming. That's still got room for growth in that regard. So while Netflix has done all of this, it has become better, like I mentioned, more effective, and look at what it's done to its operating profit margin. Look at the operating profit margin over the trailing 12 months has grown from about 3% in 2013 all the way up to 17.82% most recently in its most recent update. So this is proof of the factors I mentioned earlier with Netflix growing, adding more customers, increasing revenue. It's getting more effective at producing content that its viewers want to watch, and the increasing economies of scale makes the company more profitable, right? Because if you spend $100 million to create a movie, it doesn't cost you any more to show that movie to 200 million people instead of showing that movie to 50 million people, right? You're showing that movie anyways, so the more people that watch it, the more profitable your company becomes, right? The more subscribers, the more profitable, because you're already spending that money on content. And then if you get, 10 million more subscribers or 20 million more subscribers, that just adds to your profitability. And you can take some of that extra money that's adding to your profitability and increase your content budget to make your service that much better, to give your competitive advantage that much more room. And so this is what's happening at Netflix, and it's all pointing to the right direction for Netflix. And look at the other thing I wanted to show is its cash flow from operations over the trailing 12 months. It had been going negative for the longest time. The difference between Netflix's cash flow from operations and its operating profit margin is the way that it needs to account for its content budget. So when it spends, let's say, in 2021, it spent like $17.7 billion on content. That's cash that it spent, right? That goes against its cash flow from operations completely, one for one, that deducts from cash flow from operations. However, when you look at the income statement, when you look at profitability, that 18 or so billion dollars doesn't get deducted immediately from the income statement. That gets spread out over 3 years or 5 years or 7 years, depending on the type of content and depending on the content rules in the specific country and all of that. So that's the difference between cash flow from operations and operating profit margin, and why its operating profit margin had been positive and growing over all this time, but it was still having negative cash flow from operations. That has turned around. The company is now healthily cash flow positive. Several quarters now where TTM cash flow from operations is positive, and 2 billion positive in its most recent update. Management has said it's going to be positive from now on, right? From now on, we've reached the scale where we're not going to be negative in cash flow from operations. We will be positive, self-sustaining. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And the final reason why I think you might regret not buying Netflix stock right now on the dip is that it's trading at an attractive valuation, a forward price to earnings of just 23.49, very near the lowest it has been going back 2.25 years. So for all those reasons, I think you might regret not buying Netflix stock right now. It's a great company, great stock, reasonable, relatively inexpensive valuation. So that's all I've got for this video. Thank you so much for watching. Please click on one of the videos that I've picked out that are popping up on your screen right now, and I'll see you over there.